Welcome to Live Better Longer. I'm your host, Bill Borton. I have a very special guest today, Ron Sussman, who is the founder and CEO of CPI Companies in Voorhees, New Jersey. I first met Ron about 3 years ago, which is kind of ironic because we've both been in the insurance business and beginning in South Jersey for over 30 years. But I finally met Ron and we got together and have become friends since that time. And what I've learned about Ron is he's a student of the industry. He questions everything. He's a technician. He's a deep thinker, and he's got a strong sense of integrity, which some people sometimes find lacking in our business. But he's been a terrific partner, and Ron and his team at CPI Companies have been tremendously supportive of me in every way, shape, or form, and have made it a whole lot easier for me to do an excellent job for my clients. So, Ron, welcome to Live Better Longer.
Bill, thank you very much. Thanks for having me.
So, Ron, you and I have spent hours talking about insurance products, insurance underwriting, insurance pricing, and you've written a number of articles this year for Insurance News Net magazine, and these are all excellent. But the one that really got my attention was where you talked about how the insurance industry and the producers, the agents that sell policies used to do it, why it's not been working for quite some time, and what you're seeing now that is different. Could you tell me a little bit more about that?
Sure. The life insurance industry in general has been having problems for the last 30 years. And sales have been down. Products have been underperforming. Clients have been seeing disappointments in the returns on their policies, the cost of their policies. The industry has definitely been in a difficult situation, particularly since 2008. And the real culprit for that has basically been interest rates. Mm-hmm. There's a lot of other things going on in the industry, but if you had to point to one thing that really was forcing insurance carriers to do things they shouldn't do or to treat policyholders poorly, it's been that their interest margins have been very low since 2008, and there just doesn't seem to be any relief in sight for that.
Well, prior to that, it was easier for them to make money. And when it was easier for them to make money, it was easier for business as usual. Right?
Yes, well, there's two parts to that equation, right? One is when the insurance companies make money, they tend to behave better towards the public. When they are pressed, which they are right now, when their interest rate margins are compressed, they tend to shrink and they tend to raise rates and they tend to be less kind towards the policies they've issued. So there's two or three different things going on. Life insurance particularly is affected by interest rates. Long-term care policies have been affected not only by a decline in interest rates, but also by some very bad actuarial assumptions.
Mm-hmm. Yeah, I certainly know that, which has caused a lot of the bigger insurance companies to head for the exits and stop writing new policies.
Right.
So when I got in the life insurance business way back in 1985, and then joined the Northwestern in 1986, we were selling good old dividend-paying whole life insurance, and we were, suggesting that the cash values could be used to fund retirement income. Around that time, interest rates were in double digits, short-term interest rates, and universal life was in its infancy. And I used to refer to those days as the days of the illustration wars, which I think is where all this sort of really started.
That's true. Yeah, it's very difficult to sell a product that's intangible, that's meant to last a lifetime, but that has components that are not guaranteed, such that you'd have a very difficult time determining, if I start today, where will I end and how will that end occur? And with life insurance, particularly since the mid-'80s, where everything has been connected to interest rates and or the market, there's been a lot of volatility in those returns. And so I think it's the illustrations themselves are problematic, and I think the carriers know that, but there really isn't a solution at the moment, anything better than trying to put something on paper that says this is what it's going to cost. And to that point, mostly that's because things are not guaranteed. So life insurance, like universal life, whole life, all of those forms of insurance have non-guaranteed components, and a lot of that is related to the company's earnings and interest rates. The only products that don't have that variability are guaranteed products, and there the life insurance companies got themselves in trouble not that long ago, probably about a decade ago, just by underpricing. Mm-hmm. I think that market's starting to stabilize. I think the insurance carriers have learned their lesson about those products. But they're still having problems with older legacy products, and clients are still having problems with products. And I think one of the big issues, maybe even the biggest issue, is just that the product itself is sort of an anachronism. You're buying something for the benefit of someone else, Today, I think we really need more lifestyle products, things that benefit you while you're living, and not necessarily just a product for death.
I've seen that more and more. But let's talk for just another moment about the good old dividend-paying whole life policies that all the big mutual companies sell, many of whom have career agents, and they tend to strictly sell their company's product. What are some of the problems that we've been seeing there?
Well, the basic problem is just that interest rates have affected dividends. And so the projection that you got of what your policy will be worth 10, 15, 20 years ago is wrong. And it's always going to be wrong, but unfortunately right now it's wrong to a much larger degree than it should be. And so what people are experiencing is that they are either paying more premium than they thought they would need to pay, and or they're having to accept lesser benefits because the dividends haven't been substantial enough to meet the expectations of what the agent originally presented to them. And part of the problem with that, with whole life, is the inflexibility of the product. So in whole life, you have no choice but to pay the premium, and if you don't, the policy automatically borrows those premiums, and that's a big drag. And I don't mean that in the funny sense that it's a drag, but I mean it's a drag economically, because if you can't pay that premium or you want to pay something less, you don't have that opportunity. So fundamentally, while we think whole life insurance is a great product, as long as you're willing to hold on to it for the long term. But as time goes on, if you bought it when you were 30, it's not going to be the same product when you're 50. And it doesn't have the flexibility to accommodate changes that take place during most people's lifetime.
Good point. We're going to take a break for a word from our sponsor. We'll be back in just a moment with more Live Better Longer.
Visit AppleRidgeSeniorLiving.com
Welcome
and
back
find
to
out.
Live Better Longer. I'm your host, Bill Borton. I'm here this week with Ron Sussman, CEO from CPI Companies in Voorhees, New Jersey. Ron, before the break, we were talking about life insurance in general, but you started to talk about life insurance for the living and some of the newer products that are out there. One of the articles that you wrote that really caught my attention addressed that.
Yeah, no, I'm very excited about this. I think the insurance industry is finally starting to come around to the idea that there are other consumers out there other than the traditional people that they targeted.
Really?
No, hard to believe. But one company in particular, and I'm sure others will follow, have recently come out with products that I think really make the most sense, especially in light of who their market is going to be, which is typically going to be millennials and Gen Xers. But it's also applicable to everyone as far as I'm concerned, no matter what your age. And the idea is that they are going to be providing products that you can use during your lifetime. So rather than buy a policy where you know that the end game is really only a benefit to your beneficiary, these new products have benefits that will stay with you as you age and provide benefits for you during your lifetime that make a lot more sense. And those benefits are things like long-term care, chronic illness, and a very unique ability at age 85, and actually even a little earlier, to get the death benefit of the product paid out in 10 equal installments. So what that really means is that instead of buying a policy that's for someone else, you're buying a policy that's for you. So you have all the benefits during your lifetime of those policies. We refer to the benefits as a benefit pool because we think that people are going to be able to use them in a variety of different ways. They'll be able to get out if they want and get their money back if they feel like that's important. If they'll be able to pay for long-term care. And the products that we've been seeing lately have had indemnity long-term care riders, which means you don't have to submit bills to get paid, which is a big benefit. It's a huge relief to people who have family members in long-term care facilities, that they don't have to spend a lot of time looking for bills to get reimbursed.
We talked before about interest rates and how they can have a big impact. Now, these newer generation products, are they impacted by interest rates? Are there guarantees built in? Because I've talked a lot about a sure thing versus a maybe, and most of my clients tend to be baby boomers,
right,
and they're not interested in a maybe.
Yeah, I'm not a big fan of maybes, but as always, there will be varieties of these products. The one I like the best is fully guaranteed. So that means that the premiums you pay are guaranteed, the number of premiums you pay is guaranteed, all the benefits are guaranteed, the return on your money is guaranteed, there's no moving parts. And from my perspective, that's the best of all worlds. Now, having said that, there are people who have a risk tolerance for additional, maybe market-type returns, and there are going to be products that will provide similar benefits, long-term care, the ability to get your money when you're still alive, etc., but based on products that use the market as the measure for the return. So they will give people who feel like they have a little higher risk tolerance the ability to manage that risk and to potentially get bigger benefits. But from my perspective, life insurance is and actually all forms of insurance are about shifting risk. And shifting risk should be risk to the insurance company.
Sure.
So preferably, we would like to see people buying policies that have total guarantees. That's better for them, that's better for us, it's better for the industry.
Well, not everybody's agent or broker is going to be around when they need the benefits from the policy in the future.
Yeah, that's correct.
They're going to have to be dealing directly with an insurance company, and the people at the company aren't going to be the people that were around when that product was first manufactured.
No, in fact, if you buy a policy today, I feel like you're going to be dealing with a robot in the future. And I don't think that's too out of the realm. I think that insurance companies are trying to automate. Right now, they've got a horrible policy service system, and it doesn't work. And eventually, they're going to have to automate that system. But the real issue here is that you might buy a policy today and expect benefits 40 years from now. And 40 years from now, that agent that sold you that policy is likely not going to be here to help you navigate that difficult situation. So you're going to have to contact the insurance company. And one can only hope that when you do that, the insurance company knows what to do to get you those benefits in the most tax efficient possible way. The product that we've been talking about doesn't have that issue. Everything in that product is guaranteed, and it's a negative consent situation. When you're 85 or younger, they'll send you a notice that says, we're going to start paying you this benefit in 10 equal payments. And if you don't want it, tell us. But everyone who has that policy will say yes, because the only way to get a positive internal rate of return, meaning a positive return on your money over that long period of time, is to take that benefit when they offer it and not wait until you die.
Well, then someone else gets the positive rate of return.
Yeah, well, well, they'll get a return. It might not be positive, because if you didn't take it at 85 and you died at 95, that return would likely be negative.
That's a good point, absolutely. So this particular product also can be used again to pay for long-term care.
Right, exactly.
And so unlike some of the other hybrid policies that underwrite at the time you become chronically ill, this one they underwrite up front and charge a premium for it, so 100% of the death benefit can be accelerated when you become chronically ill.
Correct.
And so that money's paid out in cash. And what we know is that most caregivers are informal or family members,
Right.
and traditional long-term care insurance won't pay them. But this particular product can pay cash to you, and you can then do whatever you want with that cash, right?
Right, exactly. Yes, this product's an indemnity product. So when you have a claim and you can't meet 2 of the 6 activities of daily living, which is typically the trigger for all long-term care, they will pay you the benefit monthly. And that first of all, that payment is tax-free. Second of all, you don't have to submit reimbursement paperwork for that payment, so that will just automatically come to you, and you can use that payment for anything you want. It's really the best of all worlds, because the flip side of that is, what if you don't need long-term care?
Well,
And you've paid all those premiums.
then here I am, I'm either at 85 and I have the option to receive the death benefit in 10 equal installments, or I can just let it ride and let my beneficiary, possibly my spouse, receive the death benefit.
Correct.
So let's talk about that income at 85. What we know is that you can get back an amount equal to the amount you've paid in, or your cost basis, income tax free.
Correct.
So can you stop the income at that point so that you don't incur any tax and your beneficiary can receive the balance?
Yes, you can do that. And I think the most likely scenario is that people won't do that, though. I think once you get to that point and now you're using this income as, in my mind, a retirement backstop, of course you can use it for anything. But I think once you start getting the money, I think that what the income tax cost might be is almost irrelevant at that point, because you are getting the payments. And as you said, you can't stop them if you want. You can delay them if you want, and you could not take them at all. So you can manage how that money gets paid out.
But the beauty of this is, at age 85, a lot of people will know at that point whether their retirement income plan has really worked or not.
Correct.
And if it hasn't worked really well, now you've got this boost that you can receive at a time when it could mean everything.
Right, and you know, when people do planning for retirement, a lot of advisors are planning for an income that goes well beyond 85. So if you're planning for well beyond 85, you need to put more money into that plan to make that work.
Indeed.
So if you have already purchased, in essence, a portion of that payment in advance, and you know that payment's going to be paid, it's guaranteed to be paid, then you can factor that into your plans for retiring. And therefore you can put away the money to 85 and not to 100 or 105. And it will cost you less money than to fully fund your retirement plan, knowing that you've got a backstop at the end. So at the end of the day, if it's good, And that money comes in, and if you're lucky enough not to need it, you can do anything you want with it.
Terrific.
But if it goes the other way, where the market maybe isn't great in that year, you got a guaranteed payment coming in.
Good to know. We're going to take another break for another word from our sponsor. I'm Bill Borton. We'll be back with more Live Better Longer in a moment.
More about the Apple.
Welcome back to Live Better Longer. I'm your host, Bill Borton, here with Ron Sussman from the CPI Companies. Ron, tell me a little bit about CPI and what your companies actually do and who you serve.
So CPI Companies is primarily a wholesaler of life insurance products. We provide product information, back office services, underwriting, etc., to life insurance agents throughout the country.
You've got a terrific team.
We do. We have a great team of people.
They support me. They make me look smart, make me look good every day.
That's our job. Our job is to make life insurance agents look smart.
Yes.
And we've been doing this I've been doing this since 1980, but CPI Companies has been in business since 1991. We are primarily in the higher income end of the life insurance market, primarily dealing with people who have significant wealth. And our team is particularly skilled in product analysis. So, agents come to us to find out what the right products are, what's suitable for their clients, why that product might be suitable, why that carrier might be suitable. We provide all of that information to the agents so that they can better serve their clients.
So how do you analyze products and determine which carrier, which products, how to structure the pricing, and so forth?
Good question, Bill. That's really more of an art than a science. And we've got a team of people who have been with us for a long time. And they are analysts, so they've spent a lot of time with insurance companies, learning the products, understanding the actuarial assumptions of the products.
Asking tough questions.
Asking the questions most people don't ask.
Yeah.
That's right. And then we try to synthesize that and provide that information to the agents and hope that the agents take the advice and go out and sell the right products. And more than just sell them, manage them, because we believe more than anything else that we're client advocates and we're in this business to make people succeed. We want those products to succeed. And in life insurance, that's an art.
So what else do you do?
So we also have a company called PolicyAudits.com. And PolicyAudits.com is an interesting company. It provides fiduciary level audits of life insurance policies. And I don't know if you ever really think about this that much, but most life insurance policies are owned by third parties, typically trustees.
Particularly the bigger policies.
Particularly.
The ones where it really matters the most.
That's right, exactly. People pay a lot of money for life insurance, but they tend to take the policy and put it in a drawer. PolicyAudits.com is all about auditing those policies and making sure that the clients are getting the information they need to do one of two things: either manage those policies to success or to replace those policies with something that's more suitable for them at the time of life that they happen to be in when they come to us to audit the policies. And as you know, it's sort of a continuum. People need different things at different stages of life, and products need to be flexible and be able to provide those things. Funny enough, a lot of them really are, but agents don't understand them well enough to support them well. And so we wind up doing that for clients directly, where we audit their policies. We provide the financial data, we provide the actuarial data, and we show the clients what the market looks like for alternatives that might actually work better for them.
So in other words, you tell them whether they should keep the policy they have, if they should keep it, should they adjust it in some way,
Right.
and if they should replace it, then you give them real alternatives based on real numbers, because your underwriters actually do the medical underwriting in advance.
That's right. So what's really unique about policy audits is suitability and underwriting, which are really the two most important things. Number one, is it the right thing for you? That's very important. We interview the clients to find out why they have it, what it's for, what they're going to do with it, how they're going to use it, and how we can help them make that better. But none of that is valuable unless we know we can actually help the clients make a change. And in the insurance business, that means medical underwriting. So we also have a conversation about that. Once we get that data, we really know whether or not there are things you can do or not. I mean, obviously, we don't want to make a recommendation that you can do something knowing that you can't.
So people who'd be interested in PolicyAudits.com, let me think, would be insurance producers, people who have purchased large policies a while ago, trustees, both individual and institutional, correct?
Correct.
So,
Yeah, we're finding that most of the business that we're getting for PolicyAudits.com is coming from attorneys. It's primarily those people who have a fiduciary responsibility for those policies to work, who really don't have an in-depth knowledge of life insurance. So we're getting most of our audits from advisors.
So Ron, this has been terrific. And in the time that we have left, I want to make sure that our viewers, particularly those people who might be watching this on demand later, who are insurance agents or brokers, know how to get in touch with you and your team.
So the best way to do that is through my website, cpicompanies.com,
Okay.
and or a direct phone number, 800-732-8062.
Wonderful. So in the few minutes we have left, Ron, what else is there that's on your mind that we should be paying attention to?
Well, there's lots of things happening, Bill. One of those things is that insurance companies decided to raise costs of insurance rates for older clients, and we are working with the class action industry to try to stop those COI rates from going up.
Mm-hmm.
And there's some very interesting things happening today and in the near future that may actually have an impact for 100 to 200,000 policyholders that will be very beneficial.
Wow, that's terrific.
Yeah.
So that's your activist hat that you
Yes,
put on from time to time.
exactly right. That's it. Yeah, when we say we're client advocates, we really mean that sincerely. We are trying to affect positive change in the industry. We're trying to make sure that when people buy things, those products succeed, that people feel good about them, and that they don't feel like it's an old, anachronistic industry that they don't have any emotional relationship to, when in reality it's an industry that provides very substantial and valuable benefits for people.
And you're sought after by people who are interested in doing things the right way, both in the consulting end of things as well as at the insurance carrier end of things.
Yeah,
correct?
that's correct. Yeah, we deal with consultants, carriers, agents. We're really involved at a high level in the industry, trying to affect positive change, trying to make sure that the products that we sell are the right products for the right people, and that the insurance companies live up to their promises.
And some of your people have come up with some pretty cool graphics and analytics that they make available to your producers, correct?
Yeah. Producers who come through CPI companies will have a very unique experience, and one part of that is being able to have everything they do customized for them based on the way they present to their clients. And we have very, very talented people who can do incredible things with presentations, with graphics, with analytics, with probability analysis, you name it, just anything you can think of that will help clients make good decisions and make them feel right about the decisions they've made in the long term.
And I could personally attest to all that, Ron.
I'm so glad to hear that.
Yes, thank you very much. This has been Bill Borton and Live Better Longer with my guest Ron Sussman from CPI Companies. Next Tuesday, I'll be back here at 11 at RVN TV for another edition of Live Better Longer. Meanwhile, Ron, thank you.
Thanks, Bill.
And thank you.